Imagine you're trying to build something solid, something robust, to handle unexpected shocks and shifts. But you don't know how the very materials you're using behave when pressure is applied. Do they stick together? Do they push apart? Or just wobble around independently?
Yeah, understanding that interplay is crucial.
Absolutely fundamental, especially when those blocks are the assets in your investment portfolio.
And that's exactly what we're looking at today. In the world of finance, that relationship, that tendency of different assets to move together or maybe move apart is quantified by a really powerful statistical measure, the correlation coefficient.
Okay, let's unpack this then. We've gathered a stack of sources here, a mix of in-depth analysis, some academic research papers, practical educational articles.
A good mix.
And our mission in this deep dive is to really pull out the most important nuggets of knowledge. We want to truly understand how correlation works, why it's not just some academic concept, but a critical tool for anyone investing in U.S. asset classes like stocks, bonds, commodities, real estate.
Right.
And maybe most fascinatingly, we want to uncover the powerful macroeconomic forces that are really shaping these relationships behind the scenes.
Exactly. We'll start with the nuts and bolts of the correlation coefficient itself, then explore why it's so foundational for managing risk, building a well-diversified portfolio.
Makes sense.
After that, we'll dig into what the sources tell us about the specific historical relationships between major U.S. asset classes. How they've actually behaved.
Okay.
And finally, we'll pull back the curtain and look at the underlying economic factors, the big picture drivers that influence how these assets interact.
Sounds like a solid plan. Let's jump right into the absolute basics. When we talk about correlation in finance, what exactly are we measuring?
At its core, correlation is simply a statistical relationship between two variables. Think of any two series of data that change over time, say the daily closing price of Apple stock and the daily closing price of Microsoft stock, or maybe the price of oil and the level of unemployment. Correlation tries to capture the degree and direction to which these two variables move together.
And the correlation coefficient is the number that sums that relationship up.
Precisely. The most widely used one, often called Pearson's R, it distills that relationship down to a single value. And this is a number that has very specific boundaries. It always falls somewhere on a scale between -1.0 and +1.0.
Okay, so tell us about those boundary numbers and the midpoint. What does +1.0 tell you? What does 0 tell you? And what about -1.0?
Great question. Let's start at the extremes. A correlation coefficient of +1.0 indicates a perfect positive correlation.
Perfect positive?
Yeah. This means that whenever one asset's value increases, the other increases by a perfectly proportional amount. And whenever one decreases, the other decreases proportionally. They move in lockstep,
Exactly the same direction, same relative rate.
every single time. Now, in the real world, perfect correlations like this are, they're rare, but thinking about it helps illustrate the concept.
Like two price charts that look absolutely identical, maybe just scaled differently.
Precisely. Now, at the opposite end, Mega's 1.0 represents a perfect negative or inverse correlation.
Okay.
Here, the assets move in completely opposite directions. If one goes up, the other goes down by a corresponding amount, and vice versa. They are perfect mirror images in their price movements. Mirror images. Again, true Negus 1.0 correlations are highly theoretical, but they represent the strongest possible inverse relationship.
So one zigs, the other zags. Completely anti-correlated.
Correct. And right in the middle, a correlation coefficient of 0 signifies no linear correlation.
No linear correlation. Important distinction.
Very. The movements of the two assets don't appear to have a predictable straight-line relationship. Knowing how one moves doesn't give you a linear prediction of how the other will move. They essentially behave independently of each other, at least in a linear sense.
Okay, so the sign, the plus or minus, tells you the direction same way or opposite ways. And the number itself, the absolute value, tells you the strength of that linear relationship.
That's the key takeaway. The closer the coefficient is to either +1 or -1, meaning the higher the absolute value, the stronger the linear relationship is.
Right.
So a correlation of, say, +0.9 suggests a very strong tendency to move together in the same direction. A correlation of -0.7 suggests a strong tendency to move in opposite directions.
Okay.
And something like +0.1 or -0.1 suggests a very weak linear link. The assets might be moving, but not in a predictable correlated way relative to each other.
Got it. It sort of puts a number on the degree of codependency, you could almost say. How is this number actually calculated? Is it something we need to, like, worry about doing ourselves?
Thankfully, no, you generally don't need to calculate it by hand these days. Software does it for you.
Yeah.
But conceptually, the most common method involves looking at the covariance of the two variables.
No.
That's a measure of how much they move together relative to their individual average movements, and then scaling that by their individual volatilities or standard deviations.
Scaling it.
Well, dividing the covariance by the product of their standard deviations standardizes the measure. It ensures it always falls between -1 and +1, regardless of the asset's price scales or volatility levels. It's basically a way to quantify how much of their individual variability is shared in their joint movement.
So it's a quantitative measure derived from historical price data, essentially boiling down a whole history of movements into this single number between -1 and +1. And this number is used widely, right, for assessing risk, building portfolios.
Absolutely. It's a foundational concept in finance. It's used to understand the relationships within a portfolio, to inform trading strategies, and it is absolutely fundamental to modern portfolio construction and the whole concept of diversification.
Diversification.
Which brings us neatly to the next crucial point, why this measure is such a big deal, particularly when we talk about managing investment risk.
Okay, so why does correlation matter so profoundly for building a portfolio?
Well, it is the bedrock of effective portfolio diversification. To understand why, we first need to briefly touch on different types of risk in investing. There's systematic risk, often called market risk.
Market risk, right.
This is the risk inherent in the broad market or the entire economic system. Think of a major recession, a global pandemic, or maybe a widespread change in interest rates by the central bank.
Yeah.
These events tend to affect nearly all asset classes to some degree.
That's the risk you can't really avoid just by buying different stocks because it impacts the whole system, right?
Exactly. You're exposed to it just by being invested in the market at all. But then there's unsystematic risk,
Okay.
also known as specific risk or idiosyncratic risk. This is risk that is unique to a particular company or an industry or a specific asset. Labor strike at one factory, a lawsuit against a single company, or maybe a natural disaster impacting a specific region where a real estate asset is located.
And this is the risk you can potentially reduce.
Yes. Unsystematic risk is the type that can be significantly reduced through diversification, and correlation is the key tool that helps you do that effectively.
Yeah.
By combining assets that have low or even negative correlations with each other, you can lower the overall volatility and unsystematic risk of your entire portfolio.
Tell me more about how combining low or negative correlation assets reduces risk. What's the mechanism there?
Okay, think back to those definitions. If you combine assets with high positive correlation,
Like our Apple and Microsoft example, maybe?
potentially, yeah, they tend to move up together and down together. When times are good, great, your portfolio surges. But when times are bad, they both fall, potentially amplifying your losses. Your portfolio's volatility is essentially the average of their individual volatilities, plus that boost you get from them swinging together.
They're reinforcing each other's movements. It's like they're singing in harmony, but sometimes it's a sad song.
Exactly. Now, if you combine assets with low correlation, their movements are mostly independent. When one might be having a bad day or week, the other might be flat or even up. The ups and downs of individual assets don't line up perfectly.
Right.
The volatility of one isn't adding directly to the volatility of the other.
So they're not amplifying each other's swings. The overall ride feels smoother, less jerky.
Precisely. And if you manage to combine assets with negative correlation, they actively move in opposite directions. When one is falling, the other is tending to rise.
The seesaw effect.
Kind of. The gain in one asset helps to offset the loss in the other, leading to a much more stable portfolio return trajectory over time, potentially for the same expected return. This is the core idea. Diversification isn't just about owning different things. It's about owning things whose returns aren't perfectly synchronized, whose movements tend to cancel some of each other out, reducing the portfolio's overall risk.
This sounds like the foundation of modern portfolio theory, doesn't it?
Absolutely. Modern portfolio theory, or MPT, pioneered by Harry Markowitz, mathematically formalized this concept. It showed how investors can use correlation, along with expected returns and volatility, to construct portfolios that sit on the efficient frontier.
The efficient frontier.
Yeah, that's the set of portfolios that offer the maximum possible expected return for any given level of risk, or, conversely, the minimum possible risk for any given expected return. correlation is a fundamental input into those calculations.
How so?
Well, by choosing assets with lower correlations, you can achieve the same return target with less overall portfolio volatility, or potentially achieve a higher return target for the same level of volatility compared to a portfolio stuffed with highly correlated assets.
Okay, let's make this concrete with some examples. If I build a portfolio just of, say, tech stocks, what's the likely correlation picture there?
If you're buying shares in multiple large-cap tech companies, they're all likely influenced by similar macroeconomic factors, right? Interest rates, consumer spending on technology, global supply chains, investor sentiment towards growth stocks.
Yeah, they swim in the same pond.
Pretty much. Their earnings are likely tied to similar trends. So you would expect a relatively high positive correlation between them. If one reports good earnings, chances are its competitors might also be doing well. When market sentiment turns against tech, they often all fall together.
So not much diversification benefit against big market moves.
Exactly. Combining them provides some diversification within the tech sector, maybe reducing company-specific unsystematic risk slightly, but it doesn't offer much protection against systematic risk that affects the entire sector or market.
What about combining stocks and bonds? That's a very common approach, the classic 60-40 portfolio idea.
That's where correlation becomes really interesting, and as we'll see, sometimes quite complex. Historically, stocks and bonds have often shown weak, positive, zero, or even negative correlation.
Why is that?
Their drivers are fundamentally different. Stocks represent ownership in companies and are sensitive to profits, growth, and risk appetite. Bonds are debt instruments, and their prices are highly sensitive to interest rates and credit quality.
Different engines driving them.
Exactly. Because these drivers are often distinct, or even move in opposite directions depending on the economic regime, combining them can create a more stable portfolio. When stocks are volatile due to growth concerns, bonds might perform well if interest rates are falling.
Ah, the flight to safety.
Right. Or when inflation is a worry pushing bond yields up and prices down, stocks might still be rising if growth is strong. It's this difference in drivers that often leads to lower correlations and those diversification benefits.
And adding something like real estate or commodities into the mix, how does that change things?
That's adding asset classes, whose returns are often driven by a completely different set of factors than stocks or bonds. Real estate is tied to local market dynamics, rental income, property values, and importantly, as we'll discuss, debt financing.
Okay.
Commodities are influenced by supply and demand fundamentals for raw materials, geopolitical events, and currency movements, another point we'll definitely get into. These assets might have correlations near zero or even weakly negative with traditional stocks and bonds, offering significant diversification benefits precisely because their performance doesn't march to the same beat.
So the goal is basically to build a portfolio where the components aren't all reacting to the world in the exact same way at the exact same time.
Precisely. It's about finding those combinations where the movements are less synchronized, reducing the overall portfolio's vulnerability to swings that affect only one type of asset. This is why understanding correlation isn't just theoretical. It's a crucial, practical tool for managing risk in the real world of investing.
Okay, with the basics established, let's dig into what our sources reveal about the specific correlation relationships within U.S. asset classes. We have some fascinating data points here, starting with what one source describes as the evil twin relationship between the U.S. dollar and commodities. That sounds dramatic.
It's a very striking description, isn't it? And the historical data presented provides some powerful visual evidence for it. The parameter source includes a chart, Figure 1, which overlays the performance of the U.S. dollar index, the DXY.
Which tracks the dollar against other major currencies.
Right, against a basket of them. And it overlays that with the Bloomberg Commodity Index total return, the BCOMTR, over a full decade, from 2010 to 2020.
And looking at that chart, they look almost like perfect mirror images of each other for long stretches.
Yeah.
When the dollar index is climbing, the commodity index is generally falling and vice versa. It's really stark.
It's quite dramatic, yeah.
Yeah.
This persistent inverse relationship has been a dominant feature of the financial landscape over many periods.
Yeah.
Now, the exact reasons for this dynamic are complex and, frankly, debated among economists and analysts.
Sure.
But the sources present two common explanations. One perspective is that commodities, being tangible, real assets, have an inherent value independent of the currency they are priced in. Since many major commodities are priced globally in U.S. dollars, when the dollar strengthens against other currencies, it effectively takes fewer of these stronger dollars to purchase the same amount of the commodity.
Ah, okay. So if the dollar is worth more internationally, the price of the thing measured in dollars has to fall to reflect that stable underlying value, like adjusting the measuring stick.
That's one way to frame it. It's like the unit of measurement is getting larger, so the number associated with the fixed quantity gets smaller. The second explanation centers more on global trade and purchasing power.
How does that work?
A stronger U.S. dollar makes goods priced in dollars, including commodities produced or exported from the U.S., more expensive for buyers using weaker currencies.
Right. They need more of their own currency to buy the same dollar-priced good.
Exactly. To maintain competitiveness in global markets, the dollar price of those commodities might need to fall. Conversely, when the dollar weakens, these goods become cheaper for international buyers, potentially boosting demand and allowing dollar prices to rise.
So either because of a repricing mechanism or global competitiveness dynamics, a rising dollar often puts downward pressure on commodity prices, and a falling dollar tends to support them.
Exactly. And the source explicitly states that the strong bull market in the U.S. dollar witnessed over a significant portion of that decade was a material headwind for dollar-based investors in commodity indexes. It contributed significantly to downturns.
And the flip side.
Conversely, a period of dollar weakness could act as a powerful tailwind for those investors.
But this inverse relationship isn't uniform across all commodities, is it? The source seemed to highlight differences.
That's a critical detail, absolutely. While the overall index shows the aggregate effect, the strength of the dollar's influence varies significantly depending on the specific commodity's characteristics. Consider WTI crude oil, for example, illustrated in Figure 2.
Okay, oil.
Oil is a highly globalized commodity. It's fungible, easily transported across borders, primarily quoted in U.S. dollars, and generally faces pretty inelastic demand in the short term with few immediate substitutes.
Right, you need it.
You'd expect its price to have a very tight inverse link with the U.S. dollar. And Figure 2 shows dramatic evidence of that tight inverse relationship over that 2010-2020 period. Really clear.
So oil is almost the poster child for this evil twin dynamic.
It really is, in many ways. Now, contrast that with a commodity like corn, shown in Figure 3.
Corn. Different story.
A bit different, yeah. While corn is traded globally, its price is also heavily influenced by regional factors like seasonal planting cycles, specific weather patterns in major growing regions, think the U.S. Midwest, and the availability and price of substitutes or alternative crops.
So local factors matter more.
They can. These factors can sometimes be more dominant drivers of price movements than currency fluctuations. And Figure 3 clearly shows a much less stringent, though still generally inverse, relationship with the dollar compared to oil. It's just not as tight.
So things like weather or planting seasons dilute the dollar's influence on corn prices compared to oil.
Precisely. And Figure 4 in the source really drives this home. It provides 10-year correlation coefficients again, 2010 to 2020, for a whole range of individual commodities against the U.S. dollar index. It's noteworthy that all of the commodities listed show a negative correlation.
All negative.
Yes, reinforcing that general inverse notion between the dollar and commodities overall. However, the magnitude of that negative correlation varies dramatically.
How so?
Metals like copper, silver, and gold, along with energy commodities like WTI and Brent crude, things that are very global, heavily dollar-quoted, consistently show stronger negative correlations, often in the, say, negative 0.40 to negative 0.60 range. Pretty significant.
And the agricultural commodities, the softer ones.
The commodities more affected by localized conditions or non-global factors like corn, wheat, soybeans, livestock, or even U.S.-centric natural gas, which isn't easily exported globally, they tend to show weaker negative correlations, perhaps in the negative 0.1 to negative 0.30 range, much less pronounced. This reinforces that while the dollar is a factor across the board, its relative importance versus other supply-demand or weather-related drivers differs significantly among commodities. It's a great illustration of how, even within a broad asset class like commodities, the correlation with another asset like the dollar isn't monolithic. It's a spectrum influenced by the specific characteristics of each individual commodity.
That level of detail is really helpful in understanding the nuances. So the dollar acts as a powerful force against commodities, but the strength of that force varies depending on the specific good. Okay, let's shift gears to another classic pairing. Stocks and bonds. Our sources suggest that this relationship has been, well, far from stable over time.
That's an understatement. The relationship between stocks and bonds has undergone really significant shifts. The Yale paper we're referencing points way back to Benjamin Graham, the father of value investing,
Graham, yeah.
who in the 1950s actually viewed stocks and bonds as having a negative correlation and incorporated that into his asset allocation advice. But, tellingly, by the 1970s, the relationship had changed quite a bit, and he dropped that particular argument from his work.
Interesting. So even Graham saw it change.
Exactly. It underscores a crucial point. Correlation is not a static, immutable number. It's dynamic and changes with the economic environment.
They don't just stay in one dance pattern forever. They change partners, change tempos.
Not at all. Looking at historical data for G7 countries, including the U.S., we see distinct periods. There was a notable persistent upward trend in stock-bond correlations that lasted until about the mid-1990s.
Upward trend, so they were moving more together.
Yes. During this phase, the average correlation across these major developed countries reached a significant positive value, sometimes as high as 0.5.
Wow, 0.5. So for a good stretch, stocks and bonds were actually moving together quite a bit, potentially reducing those diversification benefits we talked about.
Exactly. Then, since the mid-1990s, there's been a sharp decline in this aggregate correlation, trending back towards zero. This period is sometimes referred to as the reverting trend.
Back towards zero, meaning less correlation again.
Correct. And adding another layer of complexity, the correlations across different G7 countries have also tended to converge, moving closer to each other over time, with one interesting exception being Japan in the early 1990s, where its unique economic situation caused its correlation to dip sharply into negative territory, while others were still positive or neutral.
It paints a picture of complex, evolving relationships influenced by country-specific factors, but also broader global trends.
It certainly does. And it highlights the risk of simply relying on long-term historical average correlations without considering the underlying economic regimes that cause those correlations to fluctuate. 30-year average might mask significant periods where the relationship was very different.
That makes sense. The Amundi source also brought up an interesting point about correlation leverage and the distinction between aggregate stock-bond correlation, like index versus index, and individual asset correlation. That sounded a bit counterintuitive to me.
It is a bit, yeah. It's a nuance derived from mathematical portfolio analysis. The idea is that while combining assets does a great job at reducing overall portfolio volatility, making the total value swing less dramatically.
Which is what you want.
Right. But the act of diversification itself can actually increase the importance of the asset's correlation at the aggregate level relative to their individual risks.
Hang on. So the whole portfolio becomes less bouncy, less volatile.
Yes.
But within that less bouncy portfolio, how the individual pieces move together, their correlation, becomes a relatively more significant factor in explaining the portfolio's remaining movement.
That's a good way to think about it.
Yeah.
Your individual asset volatility risk might decrease significantly when you combine them, but the risk that the assets within the portfolio move together, which is essentially correlation risk, can become a more dominant characteristic of the portfolio's behavior compared to the asset's individual standalone behavior.
It's a sort of mathematical trade-off.
Exactly, a trade-off in portfolio construction. The portfolio is less volatile overall, but the degree to which its components are correlated takes on a heightened significance in explaining the portfolio's behavior. It means aggregate index-level correlations might not always perfectly reflect the average behavior of individual assets within those indexes. There's a subtlety there.
Okay, that adds a layer of complexity to think about. And the Amundi source also specifically mentioned the role of the U.S. 10-year Treasury bond in recent history.
Yes. They noted its particular function from around 2005 to 2020. During that period, the U.S. 10-year Treasury seemed to act as a kind of universal hedging asset for developed market equity exposure.
Universal hedging asset. What does that mean in practice?
It means its tendency to perform well when stocks were struggling provided valuable diversification and risk reduction benefits, especially for investors holding portfolios of global stocks. It was the go-to safe haven, essentially.
Right.
This hedging function was so valued that for periods, investors were apparently willing to accept a negative risk premium on these bonds.
A negative risk premium, so they expected to earn less than the risk-free rate.
Potentially, yes, meaning the expected return on the bond was actually lower than the theoretical risk-free rate, precisely because of the diversification utility, the hedging benefit it offered against stock market volatility.
So investors were essentially paying a premium or accepting lower potential returns on the bond side because the benefit of its negative correlation with stocks was so valuable for the overall portfolio's risk profile during that time.
Exactly. It highlights that even if the long-term average correlation between stocks and bonds might hover around zero, there have been significant periods where the relationship was negatively skewed, making bonds particularly effective as a portfolio hedge. This is especially important for tactical investors or those focused on shorter-term risk management.
All right, so stocks and bonds have this fascinating, evolving relationship driven by economic forces and these subtle portfolio dynamics. What about real estate? It's another major asset class for many investors, particularly institutional ones like pension funds and endowments.
Diversification is indeed a key driver for institutional investors allocating capital to commercial real estate. Absolutely. However, measuring correlation for private real estate assets, properties that aren't traded daily on public exchanges like stocks are, presents some unique challenges.
What kind of challenges?
Many real estate indices are based on periodic appraisals of property values, not actual transaction prices. This can lead to what's called appraisal smoothing bias.
Appraisal smoothing, what does that mean exactly?
Well, appraisals tend to adjust to market changes more slowly than publicly traded asset prices. Think about it. When the stock market drops sharply, stock prices react immediately, within seconds.
Right.
But an appraiser might not fully incorporate that shift, or maybe a recent comparable sale, into a property's valuation until the next appraisal period, which could be quarterly or even annually.
There's a lag.
Exactly. This smoothing effect makes the volatility of appraisal-based real estate indices appear lower than the true underlying market volatility. And it can also make their correlations with more volatile assets like stocks seem weaker than they might be in reality, because the appraisal values aren't reacting instantly to the same market shocks.
So the data looks smoother and less correlated just because of how it's measured, not necessarily because the underlying asset is truly that smooth or uncorrelated.
That's the concern. So you need an index based on actual sales transactions to get a truer picture of volatility and correlation.
Makes sense. Did the sources address this?
Yes, the PREA source we have specifically uses a transaction-based index, the NTIF Transaction-Based Index, or NTBI, which attempts to mitigate the smoothing bias by incorporating actual sales prices data. It's an attempt to get closer to market reality.
And using this adjusted data, what did they find about real estate's correlation over time?
Their analysis covered a significant period from the second quarter of 1984 to the second quarter of 2018, so about 34 years. And using this transaction-based index, they provided some very insightful correlation figures for U.S. commercial real estate compared to public markets.
Okay, what were those correlations during that period?
During that time frame, real estate, as measured by the NTBI, showed a correlation with U.S. equities that was very close to zero, specifically 0.07.
Practically zero.
Almost negligible linear relationship. Its correlation with total return bonds was actually slightly negative, coming in at negative 0.15.
Negative 15, okay.
And for comparison, during that exact same period, the correlation between equities and bonds in this analysis was also slightly negative, just negative 0.01.
That's striking. So during that nearly 35-year period, using this transaction-based data, real estate had a lower correlation with bonds, (0.15, than equities did, 0.01.
That's a key finding from this analysis, yes. Based on those figures, the source concluded that during that specific historical period, real estate actually served as a better diversifier for bond allocation than equities did.
That kind of flips the script on the usual stock-bond diversification story.
It certainly adds a nuance based on this data, and they dug deeper too. They looked at how much of real estate's performance variation was linked back to the stock or bond markets.
And what did they find there?
The analysis broke down the sources of return variation for real estate. It found that only a very small percentage of real estate's performance variation was explained by variations in bond market returns, just 2.3%. Tiny.
2.3%, okay.
And an even smaller fraction, less than 0.5%, 0.5%, was linked to stock market returns.
Wow, less than 0.5% linked to stocks over that long period. That really emphasizes its independent movement.
It does. The overwhelming conclusion from this part of the analysis was that the vast majority of real estate risk and return variation during that period was idiosyncratic.
Idiosyncratic meaning specific to real estate itself.
Exactly. Driven by factors unique to property markets and largely unconnected to the forces driving stock and bond returns. As the source puts it, real estate's returns largely march to their own drummer.
Which, as we discussed earlier, is exactly what you want in an asset class you're adding for diversification purposes.
Precisely. It provides a strong argument for its role in a diversified portfolio, backed by that specific transaction-based data over a long time frame.
That's a powerful finding. Okay, so we've mapped how these major asset classes have moved together, or not, they're often inverse dance of the dollar and commodities, the shifting relationship of stocks and bonds, and real estate's tendency to really go its own way. Now let's tackle the big question, the why. What are the powerful microeconomic factors that are actually driving these relationships and causing them to change over time?
Right, this is where we move from description to explanation. The sources didn't just look at correlations, they dug into the underlying economic forces. The PREA analysis, in particular, specifically examined the common exposure of these asset classes, stocks, bonds, real estate, to a range of macroeconomic factors to understand what makes them move or not move.
What were some of the key macro factors they looked at? What kind of economic levers are we talking about?
The factors explored included things like overall GDP growth, inflation, and importantly, they broke this down into the effects of expected inflation versus unexpected inflation, which is a crucial distinction.
Okay.
Real short-term interest rates, the slope of the yield curve, the difference between long-term and short-term bond yields, often seen as a predictor of economic activity.
Right, the yield curve.
The corporate bond spread that extra yield investors demand for corporate debt over, say, for government debt, which would be a gauge of risk sentiment or perceived credit risk. And crucially, particularly for real estate, as it turned out, the flow of debt in the economy, how much credit is being created and circulating. The Yale paper, focusing specifically on stocks and bonds, heavily emphasized uncertainty about expected inflation, unexpected inflation, and the real interest rate as key drivers.
Okay, quite a list of potential drivers. Let's look at the factor exposures based on the PREA analysis for our different asset classes. How did bonds react to these macro factors in their study?
As you might expect, bonds showed significant negative exposure to interest rate variables. When real short-term rates rise, or when the yield curve steepens, which often signals expectations of stronger future growth or inflation, bond prices tend to fall, leading to negative returns. That's Bond Math 101.
Makes sense. Rates up, bond prices down.
Exactly. Bonds were also negatively exposed to unexpected inflation. If inflation comes in higher than the market expectations, bondholders get repaid with currency that has less purchasing power than they anticipated, which hurts their real returns.
So inflation surprises are bad for bondholders.
Generally, yes. However, bonds were positively exposed to expected inflation.
Positively, how does that work?
Because higher expected inflation gets built into higher bond yields when the bonds are issued. Investors demand that extra yield up front to compensate for the expected loss of purchasing power over the life of the bond. So expected inflation gets priced in.
Got it. Priced in versus surprise.
Right. Bonds also showed a slight positive exposure to overall economic growth in this analysis, which might seem a little counterintuitive, but perhaps reflects periods where moderate growth keeps defaults low. Interestingly, though, they found no significant relationship between bond returns and the flow of debt in the economy.
Okay. So bonds are primarily sensitive to interest rate movements and unexpected shifts in inflation, but they benefit from expected inflation being priced into their yields.
Broadly, yes. They are the most direct play on interest rate and inflation dynamics in this framework. Now, how about stocks? Do they react the same way? According to this analysis, stocks had a different set of primary sensitivities. They were especially vulnerable to increases in risk premia, as measured by the corporate bond spread.
The risk spread.
Yeah. When that spread widens, indicating investors are demanding a higher premium for taking on the risk of holding corporate debt, often associated with increased economic uncertainty or fear of defaults, stock prices tend to fall. It's a sign of risk aversion creeping in.
Okay.
Stocks also tended to suffer when the yield curve steepened, perhaps signaling tighter future monetary policy or inflation concerns down the road. And intuitively, they were more sensitive to overall economic growth than bonds were. Stronger growth is generally good for corporate profits and thus stock prices.
Makes sense. What about inflation and rates for stocks?
Notably, in this specific analysis period and using this particular factor model, stocks did not show significant direct exposure to risk from inflation, either expected or unexpected, or short-term interest rates, or the flow of debt. Their primary drivers seem to be growth and risk appetite.
Interesting. So stocks in this framework are driven more by growth prospects and a broad risk sentiment, while bonds are more directly about interest rates and inflation surprises.
That distinction in primary drivers is key to understanding why their correlations aren't always strongly positive. They're often reacting to different aspects of the economic environment, sometimes even in opposing ways.
And real estate, Did it share any of these sensitivities according to the PREA analysis? Did it look more like stocks or bonds?
This is where the PREA analysis presented that particularly crucial finding for diversification. It concluded that U.S. commercial real estate returns were not significantly exposed to any of the same risk factors that were identified as primary drivers for stocks or bonds in this analysis.
None of them.
None of the interest rate variables, none of the inflation variables, not GDP growth, not the risk premia factors. None showed a statistically significant relationship with real estate returns during the studied period, according to their model.
That's a powerful contrast. Not sensitive to GDP growth or interest rates or inflation in the same way as stocks and bonds. That seems counterintuitive to common wisdom sometimes.
That's what this analysis indicated, looking at that long historical period. The only significant macroeconomic influence identified for real estate returns was, interestingly, the availability of debt in the economy.
Not availability of debt.
Yes, real estate returns showed a clear positive relationship with debt flow. When debt capital was more readily available, when credit markets were functioning smoothly and lending was robust, real estate tended to perform better.
So it wasn't necessarily the cost of debt, like the level of interest rates, but whether you could actually get the debt in the first place, the quantity, not just the price.
That's the specific point highlighted by the source for this period up to 2018. While conventional wisdom often focuses on how rising interest rates hurt real estate values by making mortgages more expensive, this analysis suggested that the availability or flow of financing was a more significant determinant of real estate returns during that time.
Huh.
If credit markets were flowing freely and capital was accessible for transactions and development, real estate performed well, seemingly somewhat independent of the prevailing interest rate level during that mostly low-rate period.
That's a really specific driver.
It is. The authors do add a caveat that this finding might be particularly sensitive to the specific low interest rate environment prevalent for much of the studied period, but it's a crucial insight nonetheless. Real estate's main macro driver, according to this analysis, was distinct from those driving stocks and bonds.
That distinction alone provides a strong macroeconomic explanation for why real estate tends to have low correlations with public markets. Its performance is tied to a completely different economic lever, the plumbing of the credit system, the availability of capital.
It's a very compelling argument for its diversification benefit, grounded in these fundamental macroeconomic exposures. It's not just randomly uncorrelated, there's an economic reason why.
Okay, fascinating. Let's loop back quickly to stocks and bonds, and the Yale paper's deep dive into what drives the trends and their correlation over time, those big shifts we talked about.
Right. The Yale paper focused specifically on explaining those multi-decade shifts.
Yeah.
The move from negative in the 50s to positive in the 70s and 80s, and then back towards zero since the mid-90s. They weren't trying to explain every month-to-month wiggle, but the big persistent trends.
And what did they find was the main culprit?
Their empirical results, using various modeling approaches, strongly pointed to one dominant factor: uncertainty about expected inflation, particularly long-term expected inflation.
Uncertainty about expected inflation. So how unsure investors are about where inflation is heading years down the road is the key driver of whether stocks and bonds move together or apart over the long run.
That's what their research strongly suggests. They found that periods of high uncertainty about long-term inflation expectations were strongly associated with shifts in stock-bond correlation trends.
What about other factors like real rates or inflation surprises?
They found that uncertainty about the real interest rate and uncertainty about unexpected inflation also played a role. But these factors were less dominant than expected inflation uncertainty in explaining the major trends. Their effects were sometimes more apparent only when the impact of expected inflation uncertainty was statistically adjusted for. Expected inflation uncertainty seemed to be the main story for the big picture shifts.
How does inflation uncertainty theoretically cause them to move together or apart? What's the logic there?
Well, the paper touches on economic models that provide a theoretical basis for this. Generally speaking, these models suggest that if the primary risk in the economy is perceived to be related to inflation, meaning investors are mostly worried about unexpected inflation spikes or big changes in expected inflation, this tends to favor a positive correlation between stocks and bonds.
Why positive?
Because both assets can suffer from unexpected or high inflation, albeit in different ways. Bonds suffer directly through reduced real value of their fixed payments. Stocks can suffer potentially through rising input costs, pressure on profit margins, or higher discount rates used to value future earnings. So, inflation cheers can hit both.
Okay, and the alternative?
Conversely, If the dominant risk is related to growth, meaning investors are mostly worried about recessions or economic slowdowns, this tends to favor a negative correlation
Because,
because bonds often act as a safe haven when growth falters. Central banks might cut rates, making existing bonds more valuable while stocks obviously decline in a recessionary environment. So growth fears make them move oppositely. The Yale paper's empirical finding is that while both forces exist, it's uncertainty about inflation expectations that has been the stronger driver of the long-term trends in their correlation over recent decades.
so the inflation channel has been more dominant in setting the long-term correlation pattern recently than the growth channel.
According to their findings, yes.
And they found business cycles themselves didn't clearly drive the trends in correlation.
That was another interesting finding from that specific analysis. Despite the intuition that correlations might change predictably across booms and busts, their model did not find a clear, systematic effect of business cycles on the major trends in stock-bond correlation. Cycles might influence shorter-term fluctuations, sure, but not necessarily the big, decade-long shifts in the average correlation level.
This is incredibly insightful. It really shows that while correlation is a number, it's a number shaped by these deep, fundamental shifts in the economic forces driving asset prices, especially inflation expectations. But of course, correlation isn't a perfect crystal ball. We absolutely need to talk about its limitations and nuances.
Absolutely. Like any statistical tool, correlation coefficients have crucial limitations that investors must be aware of. Probably the most fundamental, and one that really can't be stressed enough, is that correlation does not imply causation.
The classic statistics mantra. Just because two things move together doesn't mean one is directly causing the other to move.
Exactly. They might both be reacting to a third unseen factor. Or, their correlated movement over a specific period could be purely coincidental, especially with enough data points. The TIO market source uses a good example. Airline stocks and shipping stocks might show a positive correlation.
Okay.
But it's probably because both industries are significantly impacted by the price of fuel, specifically oil. It's not that changes in airline stock prices cause changes in shipping stock prices, or vice versa. The common driver is the price of oil. You need to understand the underlying economic drivers, not just look at the correlation number in isolation.
Good point. And correlation only measures linear relationships, right? That came up earlier.
That's another key point. The Pearson correlation coefficient, which is the standard one we usually talk about, is specifically designed to measure how well a straight line describes the relationship between two variables.
So if it's not a straight line,
If the relationship between two assets is significantly nonlinear, maybe they only move together after one crosses a certain price threshold, or the relationship follows some kind of curved path, the correlation coefficient might be low, suggesting no relationship. Even if there is a strong, predictable, nonlinear relationship, it just won't capture it accurately.
so it can miss more complex patterns.
Definitely. And perhaps the most practically relevant limitation for investors, as we've already hinted at quite a bit, is that correlations are not constant. They change over time, sometimes dramatically. This is huge. It's probably the biggest challenge in using correlation for portfolio building. The correlation number you calculate from the last 5, 10, or 20 years of data might be significantly different from the correlation over the next 5, 10, or 20 years.
Why did it change so much?
Market conditions shift. Central banks change monetary policy. New regulations come into effect. Geopolitical events happen. Financial crises erupt. All of these things can fundamentally alter the relationships between asset classes.
And we've seen this vividly in recent history, haven't we?
Absolutely. The Saxo Bank source highlights this really well with examples like the 2008 global financial crisis. Assets that typically had low or even negative correlations like stocks and certain types of credit instruments or even different international stock markets suddenly saw their correlations spike to highly positive levels.
Everything went down together.
Pretty much. Everything plunged together, drastically reducing diversification benefits right when investors desperately needed them most. More recently, the inflationary environment of 2022 saw both stock and bond markets decline simultaneously for much of the year.
Right, that broke the mold for a lot of people.
It really did. It broke that traditional pattern where bonds often serve as a buffer when stocks are falling. In that case, rising interest rates enacted by central banks to fight inflation hurt bond prices directly and also pressured stock valuations simultaneously. So they both went down.
So the diversification benefit you might have expected based on historical averages can sometimes disappear or even reverse during periods of market stress or significant economic shifts, like a move to a high inflation regime.
That's the challenge. It's a major pitfall. It also leads to another nuance. Correlation can be affected by outliers or extreme events. A few periods of very high volatility or unusual movement, like a market crash, can potentially skew the calculated correlation coefficient for the entire period, making it seem stronger or weaker than it perhaps was during more normal times.
And relying solely on correlation metrics is obviously dangerous then.
Definitely. It's one tool among many. A portfolio isn't just a collection of correlation numbers. You still need to consider fundamental analysis of individual assets, liquidity constraints, transaction costs, tax implications, and maybe most importantly, your own investment goals and risk tolerance. Basing decisions only on historical correlation metrics would be a serious mistake.
This brings us back to that concept mentioned earlier. I think you called it Murphy's Law of Diversification. Sounds ominous.
It's a somewhat cynical but often realistic observation. That phrase really captures the frustration. It refers to the observation that the periods when diversification is most needed during times of market stress, panic, or certain adverse economic regimes, like those dominated by inflation risk. As the Yale paper suggested, influences stock-bond correlation towards positive.
Right.
Those are precisely the times when correlations between traditionally diversifying assets tend to increase, reducing the very benefit you are relying on.
It feels like the safety nets sometimes retract just when you're starting to fall.
It can certainly feel that way sometimes. It's a stark reminder that diversification isn't a perfect shield, and correlations are conditional, heavily influenced by the prevailing economic backdrop. They aren't guaranteed.
This has been a really comprehensive deep dive. Wow. We've gone all the way from the basic statistical definition of the correlation coefficient through its absolutely vital role in portfolio diversification and risk management. Explored the specific, sometimes surprising relationships between major U.S. asset classes like commodities and the dollar, stocks and bonds, and real estate. Seeing how those relationships have shifted.
Right, the dynamic nature.
And then peeled back the layers to reveal the powerful macroeconomic forces from inflation uncertainty to the availability of debt that seem to be the real drivers of these relationships and their evolution over time. And we've also grounded this with the critical limitations, the caveats of relying purely on this single number.
And hopefully, what stands out to you, the listener, is that correlation isn't just some static number you'll look up in a table in a textbook. It's a dynamic concept that reflects the fundamental economic forces shaping asset markets. Understanding it is absolutely key, but so is understanding its context, its drivers, and its limitations.
So here's a final thought for you to consider as we wrap up. Given how much macroeconomic factors like inflation, interest rates, economic growth, and maybe especially the availability of capital continue to shift sometimes quite abruptly these days, how might the correlations we've discussed today, particularly between assets like stocks, bonds, and real estate, continue to evolve in the coming years?
Yeah, where might they go next?
And knowing that these relationships can and do change, how does that influence how you think about building resilience and diversification into your own investment portfolio going forward? What adjustments might you need to make?
Definitely something to keep in mind as the economic landscape continues to change around us.
That's our deep dive into correlation coefficients and how U.S. assets move together, or, as we've seen, sometimes very much don't.